Let us move to the next question, which is 3.2. Let's start with 3.2.1. We need to calculate the following amounts required to complete note 1 below. We need to calculate all of this so that we can be able to complete this note over here. The first thing that they want us to calculate is depreciation. It's evident that it's actually not even given to you, and we might need to calculate it as required. Depreciation, you'll find it in your statement of comprehensive income, statement of profit or loss, and other comprehensive income. If I don't find depreciation in my statement of profit or loss or statement of comprehensive income, where else can I find depreciation? You will definitely find it in note number 3. Now, for note number 3, I want you to think of the structure of note number 3. Do you remember note number 3 will start with carrying value at the beginning of the year? Under carrying value, you'll have the cost price, and then from the cost price, you'll minus accumulated depreciation. So you will take that and minus it and get the carrying value at the beginning of the year. Do you still remember that in note number 3? That's what you will do. And then you put the amount over there. And then you're going to have movements, right? Under movements, you will have additions at cost price, and then you'll have disposals at carrying value, and then you'll have depreciation, right? These two, normally you will put them in brackets, and then you will still have the same thing in the denominator, but now it will be carrying value at end of year, and it will be made up of the cost price at end of the year minus accumulated depreciation, just like it is at the beginning of the year. Do you still remember that? Now, the method that I'm going to use to calculate depreciation has to do with this tangible asset note, but it only focuses on carrying value at the beginning of the year, right? And then under movements, we're going to have additions at cost, and then we're going to have disposals at carrying value or book value. Then we will have depreciation, and the last item will be carrying value at the end of the year. I am simply going to use those to calculate my depreciation because that is what is missing. Okay. And this is due to the fact that I wasn't even given my depreciation rate. So under fixed asset, they just said to me during the year the company sold an old vehicle at its book value of 525. Note that if you sold a car or a vehicle or any other assets at its book value, it means that the selling price and the book value will be the same. So this 525,000, we will take it to note number 3 and subtract it from note number 3 as disposal at carrying value or book value, and then take it to investing activities under the cash flow statement and write it there as proceeds from the sale of the asset. That is because there was no profit here, there was no loss. We just cashed in the true value, the equal value of the asset. Okay. And point number 2 says the company purchased a new shop as well as the required equipment for 5,541,000 rand. So that will be additions at cost. Now, I am basically going to use what I said I'm going to use. I call it, well, I got this from boys from St. David's. They call it Betty. Now, what is this Betty? It starts with balance at the beginning of the year, which is the carrying value at the beginning of the year. They call it Betty. What does this Betty stand for? It stands for balance at the beginning of the year, additions at cost, and we will have disposals at carrying value. Then you will have depreciation. The last one will be end of year balance. When you read this, obviously it'll give you Betty. All right, let's see what the carrying value is at the beginning of the year. Please note that you're given the statement of financial position. And in the statement of financial position, fixed assets are recorded at their carrying value. So here are fixed assets. So these values that are given to us here are at carrying value. The beginning of the year will be 10,325,000. That is the carrying value. At the beginning of the year, it is 10,325,000. Additions at cost. Let me just write balance at the end of the year, which is 12,476,000. When it comes to additions at cost, it was given to us under this information. It will be 5,541,000. And we have disposals at carrying value, which was also given to us, which is 525,000. Put that in brackets. That and depreciation will be in brackets. And you will notice that here we are simply missing our depreciation. So you will take this value over here, add what you subtracted, subtract what you added. It's 2,476,000 plus 525,000 minus 5,541,000 minus 10,325,000. Just need to confirm that everything is correct. it gives me 2,865,000. That will be the required depreciation. That required depreciation, when you write it in this note, you will add it back. Why do you think we add it back? We add it back because it is a non-cash item. This is what depreciation amount will be. Point number 4 requires us, or the next question requires us to calculate interest on loan. Let me see what information we've got when it comes to interest on loan. Obviously, interest on loan, you will find it in the statement of profit or loss and in the comprehensive income. It is evident that it is not given here. But this is arising from the loan. So we've got a loan from a real bank. What we need to know is whether interest on this loan was capitalized or not. Then I'll tell you what to do. It says interest on loan is capitalized. If interest on loan is capitalized, you do not need to draw the timeline or the financial year. You are simply going to use what the boys say call bury. They call it bury. All thanks to boys from Saint Benedict. What does this stand for? It is just balance at beginning of year. And then you're going to put in additional loan taken during the year. Then you will have your repayments. But these repayments, if they're given to you per month, just make sure you multiply them by 12, or make sure that you have repayments for that specific financial year, which is the number of repayments. That 12 represents the number of repayments in one financial year. And then you will have your interest for the year, which is just your interest expense. Then you will have end of year balance. Let's look at the information we've got. I will start with the balances. At the beginning of the year, the balance will be 2.8 million for the loan. We normally use this only when interest is capitalized because it means that interest was added to the loan amount. And balance at the end of the year is 3,686,000. Let's see if we have any additional loan that was taken during the year. Under loan and interest, which is 4.3, in point number 2, a new loan for 1,450,000 was taken out in order to help fund the expansion. So we do have a loan. It normally will increase the loan that we owe, which is 1,450,000. And then we've got 68,000 was paid each month to cover for monthly repayments and the interest on the loan. Most lenders worry about the monthly repayments having interest in them. Please note that interest will factor itself out. So you write those repayments, including interest over here. So the repayments amount to 68,000 rand. We are going to have 12 of these repayments. The repayments will decrease what we owe towards the loan. So I have 68,000 multiplied by 12. It'll give me 816,000. And then you work backwards. You will take this, add that, minus that, minus that. 3686 plus 816,000 minus 1,450,000 minus 2,800,000. It gives us 552,000. 252,000. That will be our interest on loan, which is what we were calculating. No surprise there. That interest on loan, we are going to record it right here. You will simply write it as 252,000. Note the depreciation we added back because is a non-cash expense. Interest expense we added back because it is shown separately on the face of the cash flow statement or statement of cash flow. This is because it is material to the users of financial statements. They need to know of the cash that their business is generating from operations, how much of it goes to the financing cost. Because to finance the business, we normally get that money from the loan and shares, but we need to know how much of that is going towards finance costs that we took to finance the business. You got it? Let's move on. The next one wants us to calculate inventories movements. Let us check what we have. They gave us trading inventory for the previous year, which is your trading stock in this case. But we have trading stock missing for the current year. For you to be calculate trading stock, they need to be giving you one of the ratios. Think of all the ratios that have trading stock in them. How many are they? It is asset test ratio, stock holding period, and stock turnover rate. We might need to use one of those. Let's read and check what we've got. They say the trade and other receivables total decreased by 268,000. Okay. A decrease in trade and other receivables means that debtors are paying up. I'm just going to jump straight into working capital. They said trade and other receivables decreased. If it decreases, it will result in a cash inflow, and it decreased by 268,000. Okay, I'm doing this in the wrong row. Got it? Then you were told that the company turns their stock over on average twice a year. So which formula are we using? Is a stock holding period? No, it is stock turnover rate. We have to find the average inventory. What is stock turnover rate? Which formula do you use? It is cost of sales divided by, this is taking all the space I've got, divided by average inventory, which is made up of inventory at end of year plus inventory at beginning of year. But all of that you divide it by 2. And then the answer that you get will be the number of times, which is twice in this case. Let's find these values. Cost of sales. It is given to us as 3,875,000. This is divided by 1/2. Inventory at the end of the year, we don't know it, it's X. Inventory at the beginning of the year, or your trading stock at the beginning of the year, will be 1,827,500. all of this will be equal to 2. I will divide this by 1. Since there's an equal sign here, I can just cross multiply. So you multiply this by that, you multiply the numerator with the denominator. What are we going to get? One times 3 million will still give you that 3,872,75,000 will be equal to 2 times a half of x plus 1,827,500. Close bracket. The 2's will cross each other out. I will be left with 3,875,000 being equal to x plus 1,827,500. To isolate x here, you will have 3,875,000 being equal to, actually minus 1,827,500 is equal to x. So you just isolate x, you transpose this one to the left-hand side. Because it's positive, it will turn and become negative. Let's work it out. 3,875,000 minus 1,827,500. It gives me inventory value of 2,047,500. Please note that this is the inventory for the current year. So the inventory for the current year will be this amount, 2,047,000 and the one for last year was 1,827,500. You will notice that it's evident that this year's one is more than last year's one. So it means that your inventory actually increased. By how much? Minus 1,827,500. It increased by 220,000. Guys, it doesn't matter whether when I subtract these two, my answer is negative or if it's positive. That does not matter. What matters is whether it is increasing or decreasing. Here I'm going to write it as it is. It will be 220,000. The increase is the one that determines whether that amount should be with or in brackets or without brackets. Because it is increasing, it will be with brackets. That is because when inventory is increasing, it means that we purchased more. When we purchased more, it will result in our cash going down. Okay, let us look at movements in payables. For you to be able to determine these movements, you need to check whether everything that needs to be excluded has been excluded or not. Can you think of things or items that we need to exclude from trade and other payables? Especially in the cash flow statement, when we're trying to determine cash inflow or outflow. Which items do we need to exclude? Give me the first one. It is SARS income tax. What else? Shareholders for dividends. What else? Accrued expense if and only if it relates to interest on loan. Fortunately here they're given to us separately, so we just need to highlight what we need. So we will definitely include trade creditors, SARS pay as you earn, income received in advance. That is all. All of these will give us trade in other payables. I'm going to include all of those here. Let's add them up and see what we get. Remember, last year, this is beginning of year. And this is end of year, which is the current year, by the way. Let's add 6,250,000 plus 64,000 plus 23,000. It gives us 6,337,000. 7,124,000 plus 51,000 plus 25,000. It'll give us 7,200,000. I'm not going to include sales, income tax, as well as shareholders for dividends. So I'm just going to leave those ones out. Okay, this is all I've got. You will notice that your trade and other payables let me do this. Your trade and other payables have actually gone up, which is good cash-wise. For future cash, it's bad, but for current year's cash, it's good. When it goes up, I need you to understand that it represents us saving some cash. It means we bought stuff on credit and we saved cash. And when we save cash, an increase in payables results in a cash inflow. And our cash inflow will be 868,000. 63,000. We can now calculate our movements by adding this with 268,000, subtract 220,000. It'll give us 911,000. It's positive. Now we're only left with our profit before taxation. Let's see what they say. Oops, they're not giving me anything here. They're giving me sales, income tax. I can't use that. Basically, they are just not giving me anything. You have to use the information that you've got. And the information that you have here is from the first question. Remember the first question? They gave us income tax. We had to calculate our income tax, which was 1,140,000. I can only be able to use that to calculate my profit if they give me the tax rate. And they did give me the tax rate, which is 30%. I'm a winner now. I am going to take that 1,140,000 because this is the 30% and I want the before will be 100%. This is the 30, so I will just divide all of this by 13. This will give me my profit before tax. I was given the tax rate. You always multiply by what do you want and divide by what you've got. I've got the 30% and I want the 100, which is my profit before tax. Let's see how much it gives us. It gives us 3,800,000. Now adjustments 4, let's see what it gives us. It gives us 3,117,000. Add these two. That will give you operating profit before changes in working capital, which will be 6,917,000. That's it. That was 3.2. Be on the lookout for the next video as we discuss 3.3. We will also do 3.4. See you soon. Thank you for your support. If you like to have lessons with me, please check out the description below. Awesome.